I'd like to welcome everybody to the take-up of Canadian Wines Incorporated. I'd like to start by identifying the following. Number one, the requireds, and number two, the specific accounting issues that you need to deal with. So let's start now with the requireds. If you take a look, what I've done here is I've copied some paragraphs from the first page of the case directly into my PowerPoint. Let's now try to start by pulling out the requireds, and then we can get into the specific issues. If you look at the first paragraph, we're told it's now September 2020. UCPA have been hired by CWI as a new controller. John Smatt, the company CEO, meets with you and gives you your first assignment. Let's take a look. He explains that the draft financial statements for the year ended June 30th, 2020 have already been prepared by the former controller, but he's concerned that some of the accounting treatments were not appropriate, given that the former controller did not have a background in IFRS. So notice how the first paragraph isn't really a required, but it's important background information that you need in order to understand the requireds. The requireds come up in the next paragraph. Let's take a look. John therefore asks you to consider whether there are any areas for which CWI's accounting treatments were not appropriate. That's the first part of the required. And if such situations exist, here comes the second part, recommend a more appropriate accounting treatment. That's the second part of the required. And then finally, and indicate the adjustment that needs to be made, the third part of the required. So at the end of the day, determine whether accounting treatments are appropriate, and if not, A, suggest an appropriate treatment, B, indicate adjustment. So there's really three parts here. Figure out if the treatment's appropriate. If not, part two, suggest an appropriate treatment, and finally come up with the adjustment. And I should mention that this is similar to accounting issues on the comp. You'll notice that some of the issues we're going to be dealing with tonight are a very high level of depth, similar to the comp. Also similar to the comp, I've asked you to do the adjustment. Very, very common on a comp to be asked to do the adjustment. I want you to get used to that. Let's continue. In cases where you do not have sufficient information to determine the amount of the adjustment, John asks that you still describe the impact of the gap deviation on the financial statements and indicate what information you require to determine the amount of the adjustments. So second sub-required here is that you may have issues where you don't have enough information to make the adjustment. You don't have the numbers that you need to make the adjustment. In that situation, what you're being told is you still have to explain the impact of the inappropriate accounting, the gap deviation on the financial statements. You'd have to explain what accounts are impacted, and you'd also have to indicate what information you need in order to make the adjustment. Okay, so you know right away when you read this that there might be the odd issue where you're not going to have sufficient information to make the adjustment, in which case you're going to need to do this. You're going to have to explain the impact qualitatively and then ask for further information. And then if you continue, it goes on to say, finally, he would like you to compute the impact of applying the accounting treatments you recommend on the amount of financing that would be available. We all know that the amount of financing is contingent on or is dependent on amounts in the financial statements, as we'll see in a moment. So obviously, if we change the accounting for some of these issues, it's going to affect accounts in the financial statement, and that in turn will affect the amount of financing available. So let's summarize now, guys. We have really two requireds that I can see. We have to determine whether the accounting treatments are appropriate, and if not, suggest an appropriate treatment and indicate the adjustment. If insufficient information is available for a particular issue, we're going to have to describe the impact of the deviation qualitatively and indicate what information we need. A second required will be to compute the impact of applying recommended treatments, the amount of financing available. This is a sort of required that would not be unlikely to come up on a comp, for example. There have been comps where you have to first consider adjustments, then figure out how they impact the state financial statements on an aggregate basis. Could be for a debt covenant, it could be for financing. This is a fairly typical situation. Now, in order to compute the impact of applying the recommended treatments to the amount of financing available, what you're going to need to do is summarize the adjustments and aggregate them, and then recalculate the impact on financing based on a formula that was given to you in paragraph 2 of the case. You were told in paragraph 2 of the case that they're able to get 60% of current assets. Financing is based on 60% of current assets and 20% of non-current assets. So if either of these two increases or decreases, that will affect the amount of financing. If an item is reclassified between current and non-current, that will also affect the amount of financing. And guys, I'll tell you what's going through my mind when I read required number 2. When I read required number 2, what goes through my mind is that there's a very high probability that one of the sub-issues, at least, will involve reclassification between current and non-current. Because otherwise, why would they bother to give you a different percentage for current versus non-current? So I'm thinking to myself, I don't know this for sure, but there's a good chance that there'll be at least one issue where classification between current versus non-current is at issue. Now, I don't want to show you what the issues are right now, but what I would like to do is the following. I'd like you guys to tell me what you think the issues are. And again, you can use the chat box for that. And once we come up with what the issues are, we'll then talk about how to analyze each issue. But I'd like you to help me first pull out the issues. So guys, I'm now going to throw it out to the virtual floor, so to speak. And I'd like you to tell me what you think the issues are. And I'll try to keep track of the issues. So anybody want to suggest some accounting issues? Okay. So one issue is inventory. I agree. I don't want to talk about yet what the issue is, but that would certainly be an issue. I see there's some others here. Let's take a look. Bear with me. Let's take a look. Boy, they're rolling in beautifully. Okay, let me just start to go through them, okay? While they roll in, I'll start to go through them. So inventory is correct. Then we've got agriculture, somebody said, and other people were a little more specific. Within agriculture, definitely people are picking up on the fact, are we dealing with a biological asset here? We know that the company treated the vines and the land in the vineyard, both the vines and the land in the vineyard was treated as a biological asset. The question is, was that correct or not? So we have a big issue around the treatment of the vines and the land. They were treated as biological assets. If they're not biological assets, that's going to have a big impact on the state. So another issue that people have pulled out is joint venture. There's a joint venture with BC Wines and whether it was treated appropriately. Excellent. Excellent. Then we've got PPE. Excellent. We have the safety equipment and whether it was dealt with correctly. Very good. Let's see what else we have. Just bear with me as I run through this. Okay. Okay. Let's just see what we got here. Good. Good. I'm seeing a lot of the same. That's why I don't want to repeat anything that I've said. A lot of people picked up classification of vines and land as biological. Investment in WWI, that's a joint venture issue. People have picked up on that. Okay, let me see if there's anything else. Revenue rec, that's a good one. Wasim, revenue rec for the new program, right? I guess you guys noticed that if you read toward the end of the case, when you get to Appendix 3, they told you that they have a new program where customers sign up on the website and they pay an annual fee of $1,000 to be a member of the premium wine discount program. So there's a question of the accounting for it. It doesn't look like the accounting was very good, right? It doesn't look like they accounted for it very I think it was pretty obvious that they did not account for it correctly, right? Basically, they told you that what they did was that the company recognizes revenue when people sign up and pay the $1,000 fee. They recognize the full revenue upon sign up. I think intuitively, most of you probably recognize that wasn't correct. I'm hoping later on tonight we'll get to the discussion of how it should have been done. So that's a good pickup. Land, people picked up, that's good. Oh, website, very good. Another one, Wasim, you picked up. Wasim says that we have to deal with the accounting for the website. Right now, in the same appendix in which they deal with the wine, in that very same appendix, they talk about the development of a website, and they tell you that all of the $149,650 of cost were capitalized, which is not correct. So we'll talk about that. Forward contract, that's a very interesting one. Sunena says forward contract. Now, question is, where does that really fall when it comes, I think what Sunena's talking about when it comes to the forward contract is, I just want to show everybody what I believe she's referring to. What she's probably referring to is, if you take a look at the fourth page of the case, we're now in Appendix 2, the second page of Appendix 2. It says that CWI often enters into long-term contracts with other producers to purchase. By the way, you shouldn't touch your face during the corona. What I just did just now is a no-no. I know the purpose of tonight's session is not to teach you about the coronavirus, but don't imitate me here. One should not touch one's face right now. It's just a force of habit. I'm sure many of you have the same problem. Anyhow, let's continue. CWI often enters into long-term contracts with other producers to purchase a particular grape which does not grow in the Niagara region. In many instances, this turns out to be profitable as the price of the grape goes up following the signing of the contract, and CWI is then able to secure the grapes at the lower price typically in the contract. The downside, however, is that on occasion the opposite situation occurs. Price of the grape declines after the contract is signed. Generally, there's an escape clause, and CWI can pay a penalty and cancel the contract. Now, here's the key thing. At year end, there were a number of contracts outstanding where the price of the grape had declined after the signing of the contract. CWI did not make any accounting entry in connection with these contracts. So I'm going to give Sunena, I'm assuming that that is the issue you were referring to when you mentioned the contract. So the question is, where does that fall? Where does that fall? Where in the handbook does that fall? And I don't want to give it away. Kshama, you have the right answer, but I'm not going to give it away quite yet. Anybody other than Kshama? Excellent. Okay, more than one of you has picked up on this. Very good. Guys, the mistake that I find that students often make is they assume that this is a financial instrument issue, and it's not. Because remember, we're dealing with a non-financial asset. And you may recall when we did financial instruments, we said that when you're dealing with when you're dealing with a derivative contract on a non-financial item like grapes, and you're planning to take delivery of the item, that would not fall under financial instruments. Here we're dealing with a derivative on a non-financial asset, grapes, and we are planning to take delivery of those grapes, so it's not a financial instrument issue, but rather, as a number of you have pointed out, it's an onerous contracts issue. So the long-term contract is an onerous contract issue. And given that this is a minor issue, we'll just deal with it very quickly before we go back to pull out further issues. What was the problem? It says over here, and there were a number of contracts outstanding where the price of the grape had declined after the signing of the contract. Should they have made an adjustment? Well, I think some of you answered this correctly. I believe somebody said they should have created a provision. I think Kshama said that, which is very good. Guys, when you have an onerous contract, do you recall, I believe Ira taught this when he was doing the section on contingent provisions, contingent liabilities, and under IAS 37, very good. Ira pointed out that when you have an onerous contract and you know you're going to lose money, you have to accrue the lesser of what? The lesser of two amounts. What are the two amounts? Lesser of? Anybody? What should they have accrued? The lesser of the penalty and the amount that they're going to lose on the contract, right? So what people are saying cost of fulfilling the contract. To be a little bit more specific, what they were really supposed to accrue is the lesser of the penalty and the amount of money they're going to lose by fulfilling the contract, the lesser of the two amounts. So by not making any entry, that would be inappropriate. This would be an example of an issue where we don't have enough information to make the adjustment. We would obviously need further information, right? We'd need to know the amount of the penalty. We'd also need to know the fee and the cost of fulfilling the contract, so we can figure out the amount they would lose. So this is a good example of an issue where we don't have enough information to make the adjustment. Okay, let's come back now to pulling out issues. I'm just going to go back now. I'm backing up a little bit, and I just don't want to leave anybody out. let's just see if we pulled out all the issues. Just give me a moment. It's trying to go way back up. Give me a moment, please. It's wonderful. So many people participated that I've got 1 million. I don't think I've had this many chats since we started the course. So let's take a look here. I'm just trying to go back to the top. Just bear with me for just a moment. This is great. Okay, I've now gone back, guys. Somebody said inventory. We already mentioned inventory earlier. Somebody has a very specific sub-issue within that. The issue of the premium wine cost, the issue is cost versus NRV. We'll get to that. That's an excellent point. So inventory is certainly an issue. Let me see if there's any other issues people have picked up that we haven't mentioned yet. We've already mentioned somebody mentions PPE safety equipment. We've mentioned that already. Trying to see here's a new issue that nobody's mentioned yet. This is the first time it's being mentioned. Manu mentions preferred shares. Yes, there's the issue of the treatment of the preferred shares. You may recall that at the very, very end of the case, on the very last page, we're told that at the end of the current year, the company issued 40,000 preferred shares, $25 per share. These shares are preferred shares which the company is required to redeem at the option of the holder of the shares in any fiscal year starting in 2024, in which, due to poor market conditions, the company generates loss from its operations. If the shares are redeemed, they will be redeemed at their issue price. So we do need to deal with the accounting for the preferred shares. Right now, we know how the preferred shares are being treated, right? We know how they're being treated on the financial statements, because if you look at the balance sheet, you can tell how they're being treated. They're being treated as equity because they're sitting in the preferred shares. And we know how they're being valued. They're being valued at $1 million. So at 40,000 times $25 per share. So the issue you need to deal with here is, should they have been treated as equity, as preferred shares, and valued at $1 million? But the only way you would have known what the treatment was by looking at the financial statements. Sometimes they will tell you explicitly how they treated a particular issue. Other times you may have to look at the financial statements or look at the notes. Okay, if it's a comp, you usually have notes to the financial statements. Let's continue and see what other issues people have picked up. I think we've now picked up almost all of them. Let's see if there's any others. I'm just going to take a look if we've got everything. You know what? I believe now we've got everything. All the issues have been picked up. Just quickly going through, but I believe we've got everything now. Bear with me for a moment, but I think we are done. Okay. Yeah, so let's go back now and look at a summary of the issues we just picked up. These are the various issues that we picked up, right? There's the accounting treatment for the vineyards, and there's really two sub-issues which I would have dealt with separately. One is the vines and one is the land. They were both treated as biological assets, and they should not have been. And in dealing with how they should have been treated, I would deal separately with the vines and the land. If you try to conflate the two, you're going to get less depth. Shavita asks a very important question, which I was going to bring up later, but I'm glad you reminded me now. Guys, what Shavita asks is, on a real CP case, would you ever have this many issues? And the answer is an unequivocal no. This case, I want to make it abundantly clear, is not intended to be reflective of a CP in terms of the number of issues. This is a case that I'm using to give you practice in applying a lot of the technical material we learned over the last few weeks to good CP type issues. So the type of issues in this case are very reflective of the CP, but you would never, even on a comp, have this many issues. I purposely built a lot more issues into this case than you would ever have on a real CP, just to give you a lot of practice in dealing with numerous types of accounting issues. Does that answer your question, Shuita? Does that answer your question? Shuita? Great. Okay. So guys, issue number one has two separate sub-issues. You're very welcome. Treatment of the vines and treatment of the land. Then there's the issue of inventory, and we'll see later on there's more than one sub-issue here. There's the issue of intangible assets, specifically the accounting for the website cost. Then there's the accounting for the safety equipment. There's revenue rec. There's the accounting for the venture with BC Wines, which is a joint arrangement. Onerous contracts we talked about already. And then finally, there's the issue of the treatment of the preferred shares. Now, as I mentioned earlier, please note that the level of depth required for many of the issues is much more representative of a comp than a multi, okay? So even though this is not a comp, I tried to give you issues, at least for some of the issues, I tried to give you the sort of depth you would need to deal with on a comp. Because the real challenge in financial accounting, in my opinion, isn't on the multi, it's on the comp. That's when they give you really meaty issues. And I tried to similarly give you some meaty issues. There are a couple of issues that probably are not meaty enough to be a comp, but some of them certainly are. What I would like to do now is I'd like to go through how to deal with various issues. The first issue that I would like you to deal with is number one. I would like you to deal with the accounting for the treatment of the vineyards. And as I said before, I would like you to deal separately with the vines and the land. If you try to conflate them, you're not going to get sufficient depth. Now, for all of the issues you deal with, starting with number one, I just want to remind you, based on the requirements, of what your analysis needs to entail. You're going to need to identify the issue and consider whether the treatment is appropriate. The key to getting competent is not coming to the right conclusion, so to speak. It may not even always be a right conclusion. The key to getting competent will be tying the technical into the case facts and only then concluding. If you immediately jump to the conclusion without tying the technical to case facts, even if your conclusion is wonderful, you would not be competent. If you conclude that the accounting isn't appropriate, you were asked to consider how the financial statements are impacted quantitatively, as long as you have numbers available. I can tell you now, for the first issue I asked you to look at, which is the vines and the land, you certainly do have lots of numbers to work with, so you will be able to figure out how the statements are impacted. I then want you to make the adjustment, okay? And that means debit X, credit Y. On comps, it is very common to be asked to make adjustments, so I want to get you used to that. And then finally, I'd like you to consider the impact on the financing. Keep in mind that if based on your adjustments, either current assets or non-current assets changed, that will obviously impact the financing. So I'll give you a few minutes. I think it'll take you at least 15 minutes to work on this first issue because it's a big issue with two sub-issues. So I think you'll need at least 15 minutes. It's now approximately 7:40. Let's reconvene at 7:55. Okay? And this is a very difficult. I'm warning you now. This is an above average level of difficulty. It's not too difficult to be on a comp, but it's definitely above average. So if you find it difficult, don't worry. You're very normal. Okay? So give it your best shot. We're now going to take up the issue of the accounting for the vineyards. We're going to deal both with the land as well as with the vines. So let's take a look, guys. What's the current treatment? The current treatment is as follows. We're told that the vineyards, including the vines and the land, both of them are being treated as a biological asset. And because of that, they're being valued like any other biological asset. How do we value biological assets? Based on fair value less cost to sell. That's what they're doing. And they're not taking depreciation on the vines. The land you in any case don't need to depreciate, but they're not taking depreciation on the vines on the basis that they're a biological asset, and biological assets are not subject to depreciation. So the way that you have to analyze the issue is you have to ask yourself, is this an appropriate treatment or not? So let's take a look first at the technical guidance, then we'll take a look at the case facts, and then we'll tie the two together. If you look at the information from Appendix 2, page number 1, this is the key information that we were given, guys. In the first page of Appendix 2, we were told the vines were planted at the beginning of 2018, January. Remember, the year end is June. In January of 2018, they were planted. When the vineyard was started with the purchase of raw land for $2.6 million. So we know what the cost of the land was, $2.6 million. The value for the vineyards in the 020 financial statements of $5,199,000 is based upon a value for the vines and the land of $2,000,000 and $3,199,600 respectively. If you add the two together, that's how you get the balance on the financial statements, on the balance sheet. The company valued the vines at $1.8 million in 018 and 019. That's what the vines were worth. For land, the fair value increased from the time of purchase to $2.8 million by June 30th, 018. So again, acquisition took place the vines were planted at the beginning of January 018, and we're told that the year end is June 30th. And for land, the fair value increased by the end of the 018 fiscal year, June 018, to $2.8 million. By 019, they were up to $3 million, and by 020 to $3,368,000. Now, vines once planted and properly taken care of will produce fruits indefinitely. However, here's a big however, and this impacts the accounting. The company plans to utilize the vines until they're 25 years old, and then the vines will be uprooted. So for all intents and purposes, they have a 25-year life, not an indefinite life. And vines become less vigorous over time. That's why they depreciate. So what we need to do now is discuss whether it's appropriate, the accounting treatment, tying back to the case facts. We're taking the technical knowledge from the handbook and tying it into the case facts. So as we said before, there are really two sub-issues. There's the issue of the vines, and then there's the issue of the land. And in order to get sufficient depth, you need to get competent, and to get competent, you want to be careful not to conflate the two sub-issues. Rather, you want to discuss each sub-issue separately. Now, you need to make maximum use of case facts. The more facts that you use, the more depth you're going to achieve. So let's start now with the vines. Okay, let's start with the vines. So we ask ourselves, was it appropriate to treat the vines as a biological asset? And as many of you have already figured out, the answer is no. They qualify as bearer plants, and therefore they are PPE, right? Now, if all you had done on a CFE is simply said they are bearer plants, you would not have been competent. What you need to do is you need to look at the criteria for bearer plants and demonstrate how the vines meet these criteria. That's what I mean by tying back to case facts. There are specific criteria that define what a bearer plant is. On the evaluation guide, they would expect you to tie back to those criteria to achieve competence. Now, what are the key facts we can tie back to? Well, pretty much what you see right here. The vines will be used to grow grapes for 25 years and will then be uprooted. So here are the technical criteria for bearer plants. A bearer plant, by definition, is used in the production or supply of agricultural produce. It's expected to bear produce for more than one period, and it has a remote likelihood of being sold as agricultural produce, except for incidental scrap sales. Now, there are two ways to write this up on a CFE. One, which I find is often useful when you have a numerous criteria, is to copy the criteria from the handbook and then simply insert the case facts under each criteria in order to tie back to them. Another way of doing it is to explain in your own words how the vines meet the criteria for bearer plants. Personally, I find it efficient to explain things in my own words when there aren't a number of criteria. When there are a number of criteria, as I said a moment ago, I find the first approach easier, although I will demonstrate both approaches. Let's start with the first approach. In the first approach, I would simply have copied the criteria from the handbook. So all I've done here is copy the criteria, and then watch how I tie back to each criterion. For A, I would have said the criterion is met. You always want to demonstrate, is a criterion met or is it not met? I would have said it's met because the vines are used to produce grapes, right? A says that a bearer plant is used in the production or supply of agricultural produce. I would have said we've met condition A because the vines are used to produce grapes, and grapes are agricultural produce. It is expected to bear produce for more than one period. Well, that's also met. Vines will produce grapes over 25 years. That's certainly more than one period. It has a remote likelihood of being sold as agricultural produce, except for incidental scrap sales. I would have said certainly met. We have no indication here that we're planning to sell the vines as agricultural produce, right? There's absolutely no such indication. So I would have said it's met. And then the final step, and this is a critical step to getting competent, you've then got to conclude. A conclusion is never implicit. You might think that given that all three criteria are met, then obviously the conclusion is that this is a bearer plant, right? You would think so, but you have to conclude explicitly. So I would have concluded explicitly. I would have concluded vines are bearer plants, therefore they should be treated as PPE and not as biological assets. You've got to conclude definitively. I often find that it's useful to use a separate subheading for the conclusion to leave no doubt in the marker's mind that you've concluded. Now, a second approach would be to simply explain it in your own words. So here's an example. As vines are used to produce grapes, which are agricultural produce, over a number of periods, 25 years, and very likely to be sold as unlikely to be sold as agricultural produce, that's a third condition, would meet the definition of bearer plants, and vines therefore must be classified as PPE and not biological assets. Here the candidate also tied back to the three criteria, but in his own words. I do prefer the first approach, A, because there are a number of criteria, so it's quick to copy them. And also it just shows the marker has no doubt in his mind. He doesn't have to think. It's apparent to the marker without giving it a lot of thought that you've met the criteria. If at all possible, you want it to be a no-brainer for the marker to say, yeah, you did what you were supposed to do. You would get the same credit here, but the marker would have to think a little more. It's best that you not make the marker think too much. It's always best if it's a no-brainer for the marker. For both approaches, guys, very important to recognize that although the vines are PPE, and this is just I shouldn't say very important, it's not a huge issue. Let me rephrase that. It's good to recognize that although the vines are PPE, the grapes themselves, while they're still on the vine, are agricultural produce. But this last point is not a critical. Now, let's talk about the land. The land, you have to ask yourself once again, was it appropriate to treat the land as a biological asset? The answer is land, by definition, cannot be a biological asset. It's excluded from the scope of IAS 41. Now, in that case, you got to ask yourself, what exactly is the land? What kind of asset is it? It would meet the definition of PPE because it's being held for the production of grapes over multiple periods, and it's owner-occupied property. You may remember that under IFRS, you've got two handbook sections for land. One would be IAS 41, and one would be PPE, and one would be investment property, IAS 40. What I'm saying to you is this is not investment property. Here it's being used by the company to produce its own grapes. Therefore, it's clearly owner-occupied property and would therefore be PPE. If I own land, if I'm a company and I own land and I rent the land to a company that produces grapes, that would be investment property. But if I own land and I'm using the land to grow grapes myself, that's owner-occupied property, it's PPE. So I would have made it clear the land underneath the vines is not a biological asset, and then I would have explained what it is, PPE. Now let's take a look at the impact on the financial statements. If we have numbers, we have to quantitatively give the impact and do the adjustment. So if we go back to the slide summarizing the case facts, you noticed that there were a lot of numbers provided, right? Remember that slide? I gave you a lot of numbers. Those numbers in that slide were taken directly from the case. Those numbers came directly off the first page of Appendix 2, the third page of the case. So at the end of the day, the first thing we need to do is ask ourselves how the accounting is impacted by treating the vineyards as a biological asset rather than PPE. So let's take a look, guys. Let's start with the vines. Given that the vines are not biological, as somebody mentioned before, I believe one of the people sent me, when I was asking people to identify the issues, somebody sent a chat that said the vines, because they're not biological assets, they should not have been valued at fair value less cost to sell, and also depreciation should have been taken. Had they been a biological asset, it would have been appropriate to not depreciate. Because they're PPE, they should, and they do have a limited life of 25 years, depreciation should have been taken. Now, given that the vines should have been treated as PPE, it was not correct, to value at fair value less cost to sell, as we said a moment ago. So the question now is, how should they have been valued? So the question is, what are the options? What are the options for PPE? So I think you probably all remember from the lectures, there are really two options when you're dealing with PPE, cost and revaluation. However, we know that CWI's accounting policy is not to use revaluation method. We're told that they use the cost method. If you look at the end of Appendix 2, they actually tell you that explicitly. Take a look, guys, at the 5th page of the case, the very last part, the very last page of Appendix 2. What you're told is, it is CWI's policy to account for all of its property, plant, and equipment using the cost model. Now, I was asking, can it be different since there are different classes? Yes, you do not have to use the same model for every class. But we're being told here that it is their policy to use the cost model for all PPE. So that's why I'm assuming that had they accounted for it correctly, they would have used the cost model. But you're right, that in theory, they don't have to, okay? The active market, Vanita, I think you're confusing this with intangibles. The concept of an active market is necessary for intangibles, not for PPE. Okay, now guys, let's talk about depreciation. Although the vines, so guys, we've now finished with, we've talked about measurement for the vines. Now let's talk about depreciation. Although the vines can produce fruit indefinitely if taken care of properly, we were told that the useful life is not indefinite, given that CWI only uses the vines for 25 years and then uproots them. So they should be depreciated over their useful life of 25 years. As they'll be uprooted after 25 years, I would have assumed a residual value of 0, right? Because if you're going to uproot them, you're not, basically that they're going to have no value at the end. So the financial statements would have to be adjusted to reflect the following. Number one, the use of cost for the vines rather than fair value less cost to sell. And number two, depreciation of the vines over 25 years. We're going to need to come up with adjustments for both. So let's take a look, guys. Let's take a look. I'm sorry, Lorraine, what is your question? Not available for use for 3 seasons? What are you saying there? You're saying that, where does it say not available for use for 3 seasons? Can you just tell me where you're seeing that? It's very hard for me to go back to that message. I apologize. I had like literally, I have maybe 50 messages here. Can you just tell me your message again, please? I'm sorry to trouble you. Okay, guys, so let's talk now about the numbers. Let's get into you're very welcome. Let's get into the nitty gritty now, okay, of the numbers. We gotta first figure out what is the adjustment gonna be, because they used fair value less cost to sell for the plant, for the vines, rather than valuing them at cost less accumulated depreciation. Let's take a look. We know from the case facts that I summarized on an earlier slide, we know from that during 2020, the fair value of the vines increased, and CWI wrote them up by 200,000 from 1.8 million to fair value less cost to sell of 2 million. That was given to us in the very first page of Appendix 2. Under IES 41, you have to ask yourself, before I can figure out the adjusting entry, I'm going to ask myself, what would the original entry have been? So when they first wrote up the vines from 1.8 million at the beginning of the year to 2 million at the end of the year, right? Because we know that the fair value less cost to sell for the vines was 1.8 million at the end of 2018 and at the end of 2019. So at the beginning of 2020, they were 1.8 million, same as the end of 2019. By the end, they were 2 million. So what would the entry have been? During 2020, the entry would have been as follows. What they would have done is they simply would have debited the vines 200,000, and they would have credited the income statement $200,000. Now, if we're going to use the cost method for the vines under PPE handbook section, then the vines should not be written up at all. When you use the cost model, you don't revalue. So The following entry would be required to reverse the write-up that would have taken place in 020. We would have to, when they wrote up the vines, as I said before, they would have debited the vines and credited the P&L, credited the gain on the in the P&L. Now that we say that they should be PPE, now that we're saying they should be treated as PPE rather than biological assets, we have to reverse that entry. To reverse that entry, we would debit the gain in the P&L 200,000 and credit the vines 200,000. So that's the first adjusting entry. Now let's deal with depreciation. The vines were planted at the beginning of January 2018, and the cost to plant them was $1.8 million. Had they been treated as PPE at the time they were planted, and had the cost method been applied, the following amount of depreciation would have been taken historically, assuming straight line. And Lorraine, if what I'm showing now is just simple straight line, but if you assume no depreciation in the early years, that would be fine too, as I mentioned earlier. So for the year ended June 30th, 2018, it was only a half a year because they were planted in January and the year end was 6 months later. So we would have had a depreciation of 1.8 million divided by 25 years times a half year, which is 36,000. For the next 2 years, it would have simply been 1.8 million divided by 25 years, which is $72,000 per year. So at the end of the day, the fact that they did not take depreciation means that they failed to take $36,000 of depreciation in 2018, 72,000 in 2019, and 72,000 in 2020. Now, the failure to take depreciation, you'd have to ask yourself, what exactly is that for accounting purposes? And here is where you needed to be familiar with IES 8, which deals with accounting policy, changes in accounting estimates, and errors. Guys, this would be considered an error. They should not have accounted for the vines as a biological asset. They should have accounted for them as PPE. So this would be an error, and you have to remember how to correct an error. An error is supposed to be corrected retrospectively with restatement of prior period financial statements if it's practicable to determine the period-specific effects. And here it would be very easy to determine the effect on each of the prior periods. So that's exactly what I'm saying in this paragraph here. In this case, it's possible to determine the impact of the error in each of the prior periods. So the financial statements would have to be adjusted retroactively or retrospectively. It means the same thing, with prior statements restated. If the most recent statements presented is 019, then the opening balance in the 019 statements would have to be restated. Very often when you show comparative financial statements, you just show the most recent year, right? The prior year. So if all we show was one prior year, we'd have to adjust the opening retained earnings. Okay? Correction. Okay, let's continue. Now, so let's take a look at the entries to correct for this error. My pleasure. Okay, the first entry, I'm retrospectively correcting the prior years. In 2018, they should have taken $36,000 of depreciation, as we saw in a previous slide. In 2019, $72,000. So by the end of 2019, they should have taken $108,000 of depreciation, of accumulated depreciation that they didn't take, right? Over the 2 years, they should have taken $108,000 of depreciation. So to correct for the prior years, the entry would be debit retained earnings, $108,000, and credit accumulated depreciation, $108,000. And this is to adjust for the depreciation that was not taken in 2018 or 2019. Okay, and you are required to make these entries. You are asked explicitly to show the adjustments, to do the adjustments. So yes, you would have had to do the entries. Okay. So Nana asks, and I adjust directly. I'm not sure what you mean by that. You'd have to do what you see here. I'm not sure what you mean by that. You'd have to give what the entry would be to correct for the error, and this is the entry to correct for the error. Okay. Okay, continuing on to the next entry. The next entry is to correct the treatment in the current year. For the current year, we failed to take depreciation expense. So to correct the current year, we would simply debit depreciation expense 72,000, which is the annual depreciation, and credit accumulated depreciation 72,000. Now, the impact on the financing, after taking depreciation, the vines would be valued on the 2020 financial statements at $1,620,000, which is 1.8 million cost, less accumulated depreciation of 180,000, right? Because remember, guys, we took 100. They would have taken, had they done this correctly, they would have taken 108,000 in 018 and 019, 36 plus 72, and another 72K in 020. So the accumulated depreciation by the end of 020 would have been 180,000. So if you take cost of 1.8 million less accumulated depreciation, the vines would have been sitting at 1.62 million. Accordingly, the value of the vines need to be reduced by $380,000 in the financial statement, right? Because at the end of the day, we have to take the difference between the amount at which they were valued on the financial statements, which was 2 million, and the $1,620,000, which is the amount at which they should have been valued based on accounting for them at cost less accumulated depreciation. So that's a $380,000 difference. It's assumed that the vines would be classified as non-current assets, given that they're being used for 25 years. So at the end of the day, non-current assets would be reduced by $380,000. And please note, guys, that it's not worth quantifying how much financing would be reduced, how much the financing would be reduced for each adjustment. The way that I would have handled a case like this is, after dealing with all of the adjustments, I would have summarized the adjustments and then figured out the total impact on financing based on the aggregate of all the adjustments, rather than figuring out the impact on financing of each individual adjustment. Let's take a look now at the adjustment for the land. Given that the land should have been treated as PPE, it would not be correct to value it at fair value less cost to sell, similar to the case of the vines. Similar to the case of the vines, we have two options now that it's PPE: cost revaluation. However, we know that CWI's accounting policy is to use the cost model. So had the company correctly treated land at PPE, we're assuming that it would have been valued at cost. And again, I'm basing this on the last page of Appendix 2, where it says explicitly that they value all their PPE at cost. Now, I should mention that if you had said something like, well, maybe they should change their policy and use the revaluation method instead for the land, given that, as somebody mentioned earlier, you can use different methods for different classes. Had you said that, that would be perfectly fine. I'm assuming that they would have used cost, but had you said that and come up with an adjustment on the basis that they will change their policy and use revaluation for land, that would have been fine. Now, assuming that they would have used the cost method rather than fair value less cost to sell, let's take a look at how we would have come up with the adjustment. What is the impact, guys, of erroneously treating the land as biological asset rather than as PPE at cost? Let's take a look. We're told that the land went up to 2.8 million by June 30th, 2018, 3 million by June 30th, 2019, and 3,368,000 by June 30th, 2020. As CWI in error applied IAS 41 and valued the land at fair value less cost to sell, what they would have done each year is they would have taken the fair value at the end of each year, and they would have multiplied by 95%, because we're told that the cost to sell is 5%. So 100% minus 5% is 95%. So they would have valued the land at the end of 2018 at 2,660,000, at the end of 2019 at 2,850,000, and at the end of 2020 at 3,199,600. Had the land, on the other hand, been valued correctly under IAS 16, and had the cost method been used, which is the company's policy, then they would have simply valued the land at the end of each period based on cost. And we know that that would be 2.6 million, okay? So accordingly, the land has to be adjusted to reflect cost rather than fair value less cost to sell. So let's take a look, guys, at the entry. Valuing the land in the vineyard at fair value less cost to sell would once again be an error. And we said before that errors are corrected retroactively, or you can use the word retrospectively, it means the same thing, with prior year statements restated. So to correct the incorrect valuation of the land and the crediting of the P&L in 018 and 019, the following entry would be made. Guys, listen carefully. What the company would have done in 018 and 019 is they would have written up the land, right? So if you take the date of purchase, the cost was 2.6 million. If we go back to this table right here, by the end of 019, the value of the land, fair value less cost to sell, is 2,850,000. So over the course of 018 and 019, they would have written up the land from 2.6 million to 2,850,000, right? So they would have credited gain, which goes to retained earnings, right? Which ultimately ends up in retained earnings because income goes to retained earnings. And they would have debited land 250,000, right? And each year they would have credited the income statement and debited land for the amount of the increase. So over the 2 years combined, 018 and 019, they would have credited the income statement 250,000, which is now sitting in retained earnings. So since they had indirectly credited retained earnings 250 when they wrote up the land, we're now going to debit retained earnings 250. When they wrote up the land, they would have debited the land 250. We're now going to credit the land 250. So what we're doing is we're correcting the write-ups that took place in the previous years by retrospectively adjusting retained earnings. Now, in the current year, we know that the land would have been written up. Let's go back to our table. From at the end of 019, it was 2,850,000. At the end of 020, based on fair value less cost to sell, it was 3,199,600. So during the 020 year, they would have written up the land from fair value less cost to sell at the end of 019 of 2,850,000, and fair value less cost to sell at the end of 020 of 3,199,600, which is a difference of 349,600. They would have debited land and credited gain in the P&L. So to reverse the entry, we're now going to debit the gain and credit the land, okay? And now we're reversing the write-up of the land. Now, what's the impact on financing? By valuing the land at cost rather than fair value less cost to sell, the land will be valued as of June 30th, 2020 at 2,600,000 rather than 3,199,000. Accordingly, the value of the land is going to be decreased by a huge amount because it should be sitting at cost of 2.6 million. Instead, it's sitting at 3,199,000. That's a $599,600 difference. Now, the land would clearly be classified as non-current. So for financing purposes, we're now going to be reducing our non-current assets by $599,600.
We hope you enjoyed watching the video excerpt. If you'd be interested in seeing the remainder of this video, as well as the review of many other challenging accounting topics, please feel free to register for the course. To register for the course, if you're not already on our website, please visit our website, passyourcpa.ca. Put your cursor over the CP module courses at the top of the screen, and you'll see a drop-down menu. Please then click on CP Technical Review. If you have any questions, we'd be delighted to speak with you. You can contact myself, Michael Levy, or my partner, Ira Wallfish. You can see our email and phone information on this slide. We very much look forward to seeing you all in this course.